He kōna I purangi tēnei nā te reo irirangi o Aotearoa.
Are we getting ripped off by our banks? Why don't we put a cap on power prices? And how long are parents and step-parents really legally responsible for their kids? Those are some of the questions we're looking at in this week's episode of No Stupid Questions. I'm Susan Edmunds, RNZ's Money Correspondent. I'm joined by Justin Gregory, RNZ's Money Question Asker.
That's not all I do. I am paid for more than that, I promise, but here we go. All right, our first question is about power prices, and it's from Michael in Levin. He says, the move to peg property rates to about the rate of inflation seems popular. Could we possibly do the same with electricity costs?
I talked to Paul Fuge at Power Switch about this. He says it would require a major restructuring of the market and the electricity price setting mechanism, and there appears to be little appetite for that at the moment. So, probably not likely. He says he doesn't believe that electricity is subject to the same inflationary pressures as many other products, though. Almost all of electricity is generated domestically, so it isn't exposed to international price shocks, for example. Up to 90% of our generation is renewable, meaning once it's built, most fuel costs for power stations are basically zero. He says it's worth noting that 80% of the generation capacity was installed more than 25 years ago. So he says it's not unreasonable for us to be asking how it could still cost so much. At the same time, the cost of new generation, particularly wind and solar, has fallen significantly. So taken together, electricity prices should have fallen relative to inflation, he says. But that hasn't happened, as we all know. So he says, after adjusting for inflation, the average electricity price today is around 60% higher than when the market reforms happened 25 years ago.
That's outrageous.
It's not great, is it? He says that's driven largely by the spot market and how that influences prices. So New Zealand has a market-based mechanism rather than a cost-plus model. So the price is set by the most expensive generator needed to meet the demand at any given time, and all generators supplying electricity during that period are paid that price, regardless of what it costs them to make the power. So electricity retailers buy power on the wholesale market, then they sell it on to us, the customers. They shield customers from the big swings that you can see in the market by offering stable prices, but ultimately it is the wholesale market that drives consumer prices over the long term. And although by far the majority of power does come from renewables, the more expensive coal and gas generation is what's setting the price most of the time, which I actually hadn't really got my head around, but it's quite interesting. And he says since 2019, wholesale prices have consistently remained above the estimated cost of building new generation. So what consumers are paying no longer reflects the cost of producing electricity. Over 25 years, generation capacity has increased less than 20%, he says. The current market structure actively incentivises scarcity, Paul says. The companies best placed to invest in new generation are often the same ones that benefit from higher prices when supply is tight, because we've got this Jen Taylor thing going on. And so investment seems to happen late rather than early, leaving the system consistently close to scarcity on power and prices elevated for long periods.
Huge sigh. Go on.
Good times. So you might have heard a lot of chat lately about how the latest round of price increases that we're seeing in our inboxes at the moment is because of lines charges. And while it is true that lines charges have increased again from April 1st this year and will rise again, over the previous regulatory period, because remember the Commerce Commission tells them what they can charge, lines prices actually fell by about 12.5% in real terms. And over that same period, the energy component of bills increased by around 3% more than inflation. So that's a lot of information to say that the market probably does need something doing to it, but tying prices to inflation probably isn't the solution we're looking for here.
Okay, next up is Nicola, who wants to know why the Australian banks operating in New Zealand are treating Kiwis like mugs and getting away with it. Shots fired there. Okay. She says Westpac, ANZ and CBA, which all have businesses in New Zealand, offer basic variable home or investment loans with full redraw facilities, and standard variable home or investment loans in Australia that come with full redraw and a 100% offset product. Now, the redraw allows borrowers to withdraw extra payments they've made above their minimum required home loan payments, usually on variable rate loans. and this reduces the daily interest charged by decreasing the loan balance, helping pay off loans faster. Funds are accessed via online banking. This is most commonly free of fees or restrictions. An offset is where you have an amount in savings that sits as an offset against the amount you have borrowed, so you only pay interest on the difference, not the whole loan amount, and you don't get interest on your savings because of course not. Nicola says in both products you are saving interest on the loans, creating a build-up of equity, allowing for your loan to be paid off in a shorter period of time, but also with the advantage of using the extra funds when and if needed. Crikey. Okay, Susan, go for it.
Well, the first thing to note here is that you can get both revolving credit facilities where you withdraw the payments you've made and offset loans in New Zealand. I actually do have a revolving credit facility with Westpac right now. And the idea is that, your money sits there and offsets the interest that you'd be paying otherwise until you have to pay your bills at the end of the month type thing. I spoke to David Cunningham at Squirrel about it.
All the banks have variable loans with redraw. So they're generally called revolving credit accounts. So they're all available. I mean, is it a basic home loan? Well, yeah. I mean, it's they're priced at the standard variable rate for banks generally, and they have redraw. They can be a reducing balance or a non-reducing balance. So pretty much those exist in New Zealand from all the banks from a redraw perspective. We're predominantly fixed rate loans, obviously, and so you can't redraw a fixed rate loan, which is why often people have a portion variable and a portion fixed, with the fixed being a lower interest rate. 3 of the major banks offer offset facilities, BNZ, Kiwibank and Westpac, and they've all offered those for a decade plus. BNZ's is probably the one that's got the most flexibility because I think you can offset other people's accounts, like other family members' accounts against your home loan.
Yes.
So that's particularly flexible. Look, I haven't got into the detail in Kiwibank. I think even Kiwibank and Westpac might be similar too. So they've absolutely got those products. Only ANZ and ASB don't have offset products. But pretty much operate just like in Australia. I've actually got one myself.
Oh, okay. Do you think the difference could be that in Australia floating rates are so much more common that maybe it's a cheaper option over there?
Yeah, that's the point. The average fixed floating rate is about 5.8, give or take a tiny bit now, whereas you can get a 4.49% fixed rate. So, I mean, if you've got a big balance available to offset, then you just have a bigger floating rate loan. Like if you've got $200,000 of assets and $200,000 of loans and $150,000 of assets, you can offset almost all of it. So, you have a bigger floating balance. So floating thing, which offsets, the interest rate's 5.8, but you're getting the benefit of 5.8 not being charged on the offset balance. And so it doesn't really, so long as you tailor your size of your floating loan to the approximate offset amount that you have, the interest rate doesn't really have too much of an impact because it's only what's left in the account that's not offsetting. And if it's a big balance remaining, you're best to fix it.
I asked him whether he thought that overall New Zealanders were getting a better or worse deal from the banks than Australians. He says the picture's not super clear and it's not dissimilar, when taken as a big picture. He says New Zealand banks pay over the odds for term deposits, which I didn't know, but less for savings, and in Australia it's the opposite. And here banks make less money out of fixed mortgages than floating, whereas in Australia it's about the same, but more people there have floating mortgages. And they don't really do cashback offers, he says. We've seen some quite generous ones lately. He says the outcome is basically the same. The margins from retail banking in New Zealand aren't that different from Australia, but different people in different parts of the market will have different experiences.
So swings and roundabouts, really?
Yeah, maybe.
We've had another question come in about blended families. In this case, a listener says her stepchildren and step-grandchild had been given trusts nurtured by her husband, and one of them bought a house with us in a city with a sea view in 2021, being obscure for privacy reasons there, I'm sure. Now, the stepchildren and the step-grandchild were told that the trusts were their inheritances, and our listener had worked alone for the last 30 years and looked after her non-working husband and felt that when the kids asked for more support from her, they were claiming from her earnings. She says in the Family Proceedings Act of 1955, a parent or the partner of a deceased parent has an undefined, quote, moral duty, end quote, to provide for their children for all of their lives. She says this needs to be ended. You cannot plan a retirement for this. Now, the Court of Appeal in 2024, according to our listener, said that a parent has, quote, no fiduciary duty to a child from the age of 25, end quote, and she thinks this should become the law. She goes on to say, my case went on for 2.5 years, and for the last 18 months of it, they had no leverage. It was time-barred, but she did not know that, and nor did her lawyers, other than threatening me, which they did often. I'm sorry to hear that. So her question is, how long are parents actually legally expected to look after children?
Yes, this sounds like a very messy situation. I talked to Otago University's Nicola Peart about this, and she says there is a bit of confusion in this question. She says there's no legal duty to support children throughout their lives, or stepchildren in this case. The Family Proceedings Act says parents are liable until the child is 16, where it's in the best interests of the child to continue until they are 18, or 20 if they're in full-time training. But there seems to be a bit of, a bit of leeway on whether it's 16, 18 or 20, depending on the scenario. Child support payments usually stop when someone turns 18 or the end of the school year that they turn 18. But it can stop earlier if they get married or start working more than 30 hours a week, apparently. Parents are generally not legally liable for any debts that kids incur once they turn 18, or for most debts before that age unless they've signed an agreement. On death, Nicola says, a parent may owe a moral duty to provide for their children from their estate, depending on the child's circumstances, the size of the estate, and any competing moral claims. If a child has no financial need and the estate is large enough to give effect to all moral claims, a court may award a child a small share of the estate, she says, to recognise the parent-child relationship if the child has been disinherited or left a very small amount.
I feel like I've had to say this a few times over the last few episodes, but best of luck to your listener. I hope it all works out the right way for everyone involved.
Indeed.
Another anonymous question now. My question is about the upcoming increase in KiwiSaver employer contributions that go to 3.5% from April the 1st. Does my employer have to apply the increase if I'm already contributing more than 3.5%?
The answer to this is if your employer is not already contributing at least 3.5%, they will need to raise it to 3.5% from April the 1st. If people request that their rate doesn't increase temporarily, that's the employee doesn't request, employers have the option of matching a lower contribution. But if the employee is contributing the higher amount, as this listener already is, then your employer has to match it.
Now one about donations. Marie says, my question is about donations, receipts for tax refund purposes. I make regular donations to a couple of charities, says Marie, good on you, and one-off ones to others, and it's common now to be given an option to add an extra amount for, quote, admin or similar. This can be 9% for Women's Refuge or 6.5% for World Vision, etc. So it's not insignificant. Now, Marie's question is, why is this amount not included in the receipt? Because it's a donation from me, Marie, after all.
Yeah, I asked World Vision and Women's Refuge about this. Women's Refuge told me that when someone makes a tax deduction for a donation, the key requirement is that the payment is a gift that is made directly to the charity and must be received and controlled by that organisation. The Women's Refuge spokesperson says the main donation amount goes directly to the refuge and it's recorded as income of the organisation, and a tax receipt can be issued for that amount. However, the optional admin or cover the fees amount is structured differently. She says, although you choose to pay this extra amount to support the charity, it doesn't go to the charity itself. So instead it goes to the payment gateway or the fundraising platform that's being used to process the donation.
That makes sense, yeah.
Yeah, it does. The charity never receives or controls those funds, so the platform retains that amount to cover its costs. And because that portion isn't received by the charity, it doesn't meet the legal requirement of a deductible gift, and therefore it can't be included on the donation receipt. And she says the structure is very beneficial for not-for-profits, so please keep doing it. Charities are required to pay transaction fees and platform costs when processing donations, and these expenses can be significant. By giving donors the option to cover those costs directly, the charity is able to receive the full value of the intended donation without those deductions reducing the funds available for its work.
But
World Vision says it should all be on the same receipt, which I thought was strange. So maybe it was the way I asked the question of them, because it makes more sense to me than the other bit.
All right, in the last week, Susan, you've written a couple of stories about benefit sanctions, Joy of Joy. What's going on there?
Yeah, Infometrics did some research into how well the benefit sanction system is working. You might remember in 2024, the government introduced its new system. There's a traffic light system where if you stop meeting your obligations as a beneficiary, you go to orange. Then if you don't fix it, you go to red. And when you're red, you can have sanctions like having your benefits stopped or reduced. But this research showed that the sanctions haven't really worked so far. And that's probably because, as we might have predicted, the labour market has been so bad you can't push people into work that isn't there. But they also pointed out that only about 1% of people have been in the red space at any time. So even if the sanctions were working, it's probably not affecting a large number of people.
That's probably true, but do we know more? Do we know who's being sanctioned?
Apparently young people disproportionately, mainly men, as well as more Māori and Pacific people. About 2/3 of sanctions were because people hadn't attended a work and income appointment or appointments with another service provider, or because they were not preparing for work. And only a small number were people who were not participating in work. I heard from people who were dealing with sanctions. One man told me that he missed a scheduled call from a case manager and then an unscheduled one from a workplacer and was sent to orange, but he couldn't access his My MSD account, so he went into red and had his benefit cut. It won't go back to normal for another week or so, he said. So it is tough going for people who are on pretty limited income anyway.
In the last episode, we asked listeners what they thought was the most expensive pet procedure covered by Southern Cross Pet Insurance. And the answer is, Susan?
Well, the owner of a dog with immune-mediated hemolytic anemia made a claim for $15,000. I hope I said that right.
Do you know what it is?
I do not. No. Someone had a dog with a disc prolapse, claimed $12,110, and someone who had a ragdoll cat with pneumonia claimed $11,000.
I've got a dog. I've got pet insurance. You've got multiple animals, haven't you? Have you got pet insurance?
I have. No, I haven't. I haven't got pet insurance. I've got 3 cats and 1 dog, and I couldn't because it's so expensive to insure 4 animals. But if I do one, I'll pick the wrong one, So I just hope for the
inevitably,
best.
it'll be the other one that ends up.
That's
yes.
right.
Yeah.
That's right. And too late now. So our question for this week is, speaking of power prices, where in the country are the highest bills?
Send us your answers, as well as any other questions you might have, to questions@rnz.co.nz. See you later.
Bye for now. No Stupid Questions with Susan Edmunds was written and presented by Susan Edmunds. That's me. Justin Gregory is the producer. The engineer is Elliot Childs. Thanks to Michael, Nicola, Marie and the 2 anonymous listeners for their questions, and Paul Fuge, David Cunningham, Nicola Peart, World Vision and Women's Refuge for their answers. Follow and listen to No Stupid Questions with Susan Edmunds on Apple Podcasts, Spotify or any podcast app so you don't miss an episode.